Geoffrey Yu of BNY writing, the November 4 refunding is the key test. If Treasury actions loosen conditions while inflation remains above target, the Fed may eventually need to offset some of that impulse. Jeff joins us now for more. Jeff, let's talk about it. We only just had one, quarterly refunding. It's a few months away now, Jeff. What's your base case?
Oh, well, right now it's about financial conditions, right? We need to look at this on a comprehensive basis. And crucially, the market is still pricing in tightening, not just from the Fed, still around the world. I think we can differentiate a bit. So, let's react to data. As I said earlier, it's really inflation that matters. If we can start seeing some non-accelerating inflationary growth, and there's some signs of that in Europe, actually, then I think conditions will be early as well. So I really don't want to preempt everything, but I don't want to preempt anything. But I think what the market's focused on in terms of financial conditions, that's pretty much clear.
I attempted and failed to get the San Francisco Fed president to engage in a conversation about that, Jeff, but clearly, if we do see an easing in financial conditions, it's something that would have to be on their radar. Jeff, can you describe what an unwarranted easing of financial conditions would look like that this Fed would need to respond to?
Can I just first say some of the chats I saw yesterday regarding your conversation, that was quite interesting as well. If we look at US financial conditions, I think there are four elements: spreads, yield levels, equity markets, and fourth, the dollar. So we need to bear in mind that the US has some intrinsic advantages here. The dollar being the world's foremost reserve currency, treasuries being the world's foremost reserve asset. So that's intrinsic, externally driven loosening. So you don't want to loosen on top of that. And we find that sometimes, even when risk sentiment is weak, when equities and bonds are selling off, the dollar tends to outperform. So you don't want to push back against that. It's about pulling different levers. You don't pull levers which loosen all four at the same time. I think that is the key message here. You need to have some offsets. So if the curve, let's say, doesn't offer as much term premium as other conditions warrant, then let's make sure the dollar is not too weak either. I think that's the holistic way of looking at it.
Jeff, is standing still the new easing of financial conditions?
So standing still in the current environment relative to where inflation is going, I think that's important. And again, we're seeing a sort of a US advantage here because, yes, yields are high and certainly not falling as much as perhaps the Treasury would like. But because break-evens haven't moved as much, that means real rates are still robust, not just for domestic investors in the US, the pension funds and the LDI managers, but for international investors as well. They would want to come in and own that. And we're seeing that in some of our own data. But you can't stand still in terms of fiscal, medium to longer term structural issues. We saw that in Japan. We're seeing that, the market demand that in the US, and you're seeing Congress move on it as well. I think that's when markets do not want to see anything standing still. They need to see action.
Jeff, you had previously talked about the end of some of this low volatility environment that we've been in, at least when it comes to the bond market. You said that the recent moves from the Treasury Department complicate that call, given the fact that there could be some manipulation, artificial control, or just sort of involvement to dampen any kind of yield moves. So what's your sense of how that is an input into the easing or tightening of financial conditions?
I'm really glad you brought that up because I can try to bring in just shoehorn forward guidance into this as well. You can't artificially suppress volatility on a comprehensive basis. You can redistribute it, right? Forward guidance sometimes is you're redistributing volatility towards the end, of that guidance. Within markets, if you suppress one area, then you introduce it into another area. So one thing we've highlighted is if you're trying to suppress fixed income vol, for example, then it may show up in foreign exchange vol or equity vol. Why carry trades aren't performing as strongly as markets feel like right now is because markets are looking for other areas to hedge that risk, right? So moves in gold, Bitcoin, as I mentioned earlier in the program, I think that's all a part of that. So let's look at volatility on a comprehensive basis, not just in one particular market.
Jeff, what's your favourite trade then, going into year end, given what we've seen and heard this week?
So right now, I'm still, looking at an environment where carry trades can outperform, but you need to be as selective as possible in terms of FX. I still like the APAC currencies, those funders with their heavier current account surpluses. I think they can perform. You're seeing in Korea already, for example. We're looking, at the Taiwan dollar, yen, of course, as another trade. Europe is actually improving. So this momentum we're seeing in European equity markets, I think that can continue as well. But, and this is a big but, this does not mean stronger euro, right? So if you ask me for another high conviction trade, I think the euro actually comes off from these levels, not just against the dollar, but also on the crosses as well.